Here is a number that should worry every aspiring funded trader. 90%. 9 out of 10 traders who attempt a prop firm challenge will fail it, not because they can't trade, not because the market was against them, but for reasons that are, almost without exception, completely preventable. In the next 7 minutes, I'm going to walk through exactly what those reasons are, backed by real industry data, and more importantly, exactly what you can do differently to be in the small percentage that actually gets funded. Let's get into it. First, some context, because the scale of this problem is bigger than most people realize. FPFX Technology analyzed over 300,000 prop firm accounts across 10 different firms. Their findings: only 14% of traders pass a challenge at all, and just 7% ever receive a payout. That is the whole pipeline. Pay the fee, take the challenge, survive the funded stage, actually withdraw. Only 7% make it. Now, the prop trading industry itself is thriving. It's estimated at $20 billion globally. Legitimate firms paid out around $325 million to traders in 2025 alone, and search interest in prop trading grew over 600% between 2020 and 2024. The opportunity is real, but here is what the data consistently shows about why people fail. It's almost never about trading ability. The dominant causes of failure are behavioral, drawdown violations, emotional decisions, and risk management errors. Things that have nothing to do with whether you can actually read a chart. So let's go through each one. Number 1, not understanding the rules properly. This sounds too simple, but misreading or misunderstanding the challenge rules is responsible for an enormous share of failures, and it catches out experienced traders, not just beginners. Most people skim the rules and start trading. Every firm is different, and in prop trading, the detail is everything. Here are the 3 areas that trip people up most. Firstly, the daily loss limit. This is typically set at 4 to 5% of your account. It resets every single day. It doesn't care how well you traded yesterday. One volatile session and it's over. Traders obsess over the total drawdown limit and underestimate this daily threshold completely. Secondly, consistency clauses. Some firms include a rule that limits how much profit can come from any single day. For example, a best day rule, where no single day can represent more than 50% of your total positive profit. If you have a big news day, you're not paid out until you generate enough additional profit to bring that percentage down. The last area of the trading rules that most failed traders overlook: trailing versus static drawdown. A static drawdown is fixed from your starting balance. If you start at $100,000 with a 10% limit, your floor is $90,000. Full stop, it never moves. A trailing drawdown moves upward as your account grows. Your actual risk buffer can shrink constantly without realizing it. The fix? Read every rule before you place a single trade, then paper trade under those exact rules for 2 weeks. The second most common cause of failed prop challenges: poor risk management and oversizing. This is the #1 mechanical cause of failure, and it comes down to a maths problem that most retail traders have never had to solve before. In your own account, risking 2 to 3% per trade feels reasonable. You're used to it. But inside a prop firm challenge, 2 losing trades and your day is done. 3 bad trades and you are out for good. Professional traders typically risk between 0.5% and 1% of their account per trade. That actually sounds small, but it means you can absorb around 10 consecutive losses and still be in the game. That risk management is what firms pay you for. There is also a critical concept many miscalculate: the difference between account balance and actual risk capital. Let's say you have a $100,000 funded account with a 6% trailing drawdown. Your real buffer is $6,000. If you risk 1% of your account at $1,000 per trade, you are actually deploying over 16% of your real capital. A few of those in a row and you are finished. The fix? Hard cap your risk at 0.5 to 1% of your balance. Set a personal daily stop loss below the firm's hard limit. If the daily cap is 5%, stop yourself at 3%. That buffer is your psychological and financial safety net. Never average into a losing position. The next common cause of a prop firm challenge loss: emotional trading and psychology. Most traders know exactly what they should do. The challenge is doing it under pressure. The evaluation changes the psychology. Your fee is on the line. There is a profit target you feel you have to hit. That pressure amplifies every emotion you already carry. Fear makes you exit winners too early. Greed makes you hold losers too long. And frustration leads to revenge trading. The emotional pressure to win money back causes traders to increase size and abandon their rules. Within minutes, a manageable loss becomes a full account breach. Emotional decision-making is the dominant cause of failure here. The fix? Create a circuit breaker and enforce it brutally. If you hit 50% of your daily stop, the platform closes. No exceptions. You are done for the day. Keep a trading journal to track your emotional state. Treat every challenge trade like it is a live funded trade. We'll take a much deeper look into trading psychology in another video. Last on the list, overtrading and no structured plan. If revenge trading is an emotional problem, then overtrading is a discipline problem. Many traders enter a challenge feeling they need to be active. Slow days feel wasteful. They take setups they wouldn't normally take. The result? Commissions and spread accumulate, and low-quality trades eat into your risk buffer. The most successful funded traders are often the quietest ones. Clear strategy, defined instruments, and most of all, patience. Some firms force you to trade on their schedule by requiring minimum or maximum trading days, even if conditions don't suit you. The fix? Write a one-page trading plan before you begin. Commit to it, even if it means sitting on your hands for several days. Even if you get all of the above right, the firm you choose still matters enormously. Many firms exited the market recently. You need a firm that is transparent and genuinely structured for success with institutional backing. That is the core of what we've built at LuxeFunded. There are no consistency rules on Forex and crypto accounts. A big winning day counts in full toward your target. There are no minimum or maximum trading days. You trade when the market suits you and your trading style, not to hit a quota. Our two-phase challenge uses a static 8% drawdown, so your risk buffer never tightens as your profits grow. Our three-phase challenge has no daily loss limit, giving swing traders the ability to hold through volatile sessions. We also offer instant funding up to $100,000 if you're ready to put your trading skills on the real markets. We also offer profit protection, and across all our accounts, you keep up to 90% of your profits, putting LuxeFunded at the top end of what the industry offers. Let's bring it together. The real reasons most traders fail: rules, oversizing, emotional trading, overtrading, and bad firms. The good news? Every single one of these is fixable before you ever place your first trade. The 90% failure rate is not inevitable. Stay disciplined to get funded and remain funded. If this was useful to you, please subscribe and give us a like. We'll be posting regularly covering risk management, helpful hints and tips, and trading psychology. When you're ready for a challenge built for your success, head over to LuxeFunded.com. See you there, and see you in the next video.